All right, what's happening? Episode 3 here. In today's episode of the Creative Acquisitions Podcast, we are going to go through the types of financing that you can get for a short-term rental. You can also apply these to long-term rentals, multifamily, commercial. Almost all of these strategies will work with any asset class, but we're going to focus on short-term rentals as a whole. And again, the purpose of this podcast series is for me to give you an explanation of some of the things that I've done within the real estate space, and hopefully that will help you get there a little bit quicker and also help you avoid some of the mistakes I've made. One of the big disclaimers I have for everybody on here is I don't have anything in particular for you to buy. This is a podcast that is just my knowledge for you, to give you information. If you have questions or comments, you can drop it in the comments below. The thing that I'm trying to achieve by doing this podcast is trying to take all the pieces that I wish somebody else helped me with and try to distill it down here inside of a podcast. One of the interesting things that I experienced is most of my knowledge that I gained along the way was not through mentorship or coaching or help. It was through a mix of Audible audiobooks, reading physical copy books, and then using a combination of Google and ChatGPT to ask very specific questions for very specific scenarios to get answers. Now, the biggest thing to keep in mind is anytime you want to learn something new, specifically in real estate, there is a ton of information online, and the problem is that most of the information is super wide and not consolidated enough. And because it's not consolidated, you're got to watch 45 minutes of somebody talk to explain the process. The goal of this podcast is to do that as quickly as possible. So let's get in. Financing. Anytime you buy properties, there are three main categories of financing. There is conventional financing, there is non-conventional financing, and then there is creative financing, okay? And conventional financing, that's going to be your 15 and 30-year mortgages that are backed by the federal government, Fannie and Freddie. Those are going to be your FHA, your VA, and just straight conventional loans. 3.5% down is typically your lowest. Conventionals go about 5% down, okay? And these are considered, and they really can go up to like 25% down, right? You can put as much down as you want. And these have a mix of three categories: primary homes, second homes, and investment properties. Generally speaking, Fannie and Freddie have 10 mortgage slots. You have one primary, one secondary, and 8 investment properties. There are times where you can go above and beyond that, but there are some exposure limits, and these are qualified mortgages. They're bought, so you have somebody who originates the loan. They are bought by the federal government, and they're sold off. So you have to keep this in mind, because the underwriting process for when you're using Fannie and Freddie, you're going to get a much better interest rate, but the underwriting is much stronger. It's typically 2 years in the same business, 2 years of W-2s, tax returns, and they really struggle with calculating depreciation. So when you do these mortgages, right, if you have tons of depreciation hitting your tax return's super negative, you are going to be very non-bankable. So me today, in my situation with lots of depreciation, income from multiple, partnerships that are going to a Schedule E, very complicated tax situation, that makes me very non-bankable in the QM space, qualified mortgage space. If you're somebody with one W-2, no rental properties, no depreciation, no partnerships, no other businesses, no Schedule E or Schedule C, just very clean businesses or clean job, you're going to have no problem getting into this. So again, qualified mortgages, 10 slots, one primary, one secondary, typically 8 investments. Can you go above that? Yes. There are something called the conforming limits. Okay, conforming limits are the max loan amount that they will issue based off the down payment. For example, I think right now the conforming limit's about like $765,000 if you want to do a second home loan, 10% down. So they're saying you can't buy a second home that's cost you more than $850,000. These are adjusted for different areas. FHA has rules, conventional has loan rules. They all have different rules, but you would do 2 years of tax returns, 2 years of W-2s, and you could put as little down as 3.5%. Really, if you're in the VA program, Veterans Administration program, you can go as little as 0% down, but that's a very niche market that we're not going to talk too much about in this. So again, conventional has VA for veterans, FHA, typically first-time homebuyers, and conventional. Conventional is going to go 5, 10, 15, or 20% down, okay? On the conforming side, okay, which is this whole category, VA loan 0, FHA 3.5, conventional 5 all the way up to 20, 25, even more if you want, okay? If you come outside of the conforming guidelines, there's something called a jumbo loan. So we're still in conventional, okay, still conventional, 2 years tax returns, W-2s. There's something called non-conforming, which is when the loan's too big, that becomes jumbo. The interest rate typically changes and the down payment typically changes. You can't usually do 10% down. You got to do 15 or 20% down once you hit jumbo category. And jumbo is based off of the real estate in your area, how much the properties are worth, and it's adjusted for each zip code or area. So that's all of the conforming loans, right? Qualified mortgages. Now you come over to non-qualified mortgages, non-QM. Non-qualified mortgages are broken into a bunch of different categories. You have bank statements. So if you're self-employed and you have 12-month bank statement or 24-month bank statement, you can submit those. They typically take 50% of the deposit amount for that loan product. They also have DSCR, debt service coverage ratio loan. They look at the rental income, long-term rental income for the property, and the debt, principal, interest, taxes, and insurance, typically wrap that together, and they calculate the debt. So if it brings in $5,000 and spends $4,000, that's a 1.25 DSCR, approved. They'll approve that all day. That requires no income on your end, right? Because it's purely qualifying on the property. So bank statement 12 months, bank statement 24 months, DSCR. And you have a profit and loss statement program, which is very similar to bank statement. It's just done by a CPA that shows your profit and loss. Maybe your bank statements don't really tell the whole picture, or maybe you don't have good bank statements or something like that. And then there are some hybrid programs that each bank has in the non-QM space. The non-QM space is significantly less regulated than the QM space, and so there's different rules associated with that. So you will see some of these hybrid programs that exist out here, international buyers, and just a bunch of different programs that exist out there. So conventional, we talked about that, VA, FHA, and then conventional. Then you jump up to jumbo if you're outside the conforming limit, right? Which again, I think is like 800,000 plus. It's adjusted for your area. Then we come over to non-QM, which is your 12 and 24 month bank statement, your DSCR product and profit and loss product. Then you come over to your seller finance or creative finance category. Within the creative finance category, you have seller financing, which is when they own the house in cash and you're making them a down payment plus payments. That's seller financing. You have subject to, which would be you buy $1 million house with a $900,000 mortgage. You put down $100K, and so the mortgage that's left is $900. That's sub 2 because the mortgage you're taking on is exactly the same as the other mortgage that exists in place. Then there is a hybrid, which would be $1 million property with an $800,000 mortgage, but you're only putting $100K down. So you would have $1 million house with $100K in cash, $100K in seller financing, and an $800K mortgage. So a hybrid is subject to, which we talked about before, plus seller financing. So just to back up, seller financing is they own the house in cash. Subject to is they have a mortgage and you're paying out all of their equity and just taking over their mortgage. And a hybrid is a combination of those two. So again, $1 million property with an $800K mortgage, but you're only putting down half of the equity, in this case, $100K. So you have $100K down, $100K seller finance, $800K subject to. That's called a hybrid or a wraparound mortgage. Now, this is going to get a little bit technical, but we'll break out the difference between a wraparound mortgage and a hybrid. Okay, on a wraparound mortgage, typically the terms of the whole wrap are the same. So if my mortgage is $800,000 I'm taking over, but mine's really $900,000 in our example, right? So $1 million house, you put down $100K, but their mortgage is only $800,000. Let's say it's $800,000 at 5% interest. A wraparound would be we have $900,000 at 5% interest. So the terms of the subordinate mortgage, the $800,000, and the terms of my full wraparound mortgage are the same. That's a wraparound mortgage when the terms are the same. A hybrid is when there's two separate notes. There's the $800,000 to the bank and the $100,000 to the seller. Because they're two separate notes, you can have two different sets of terms, two different interest rates, two different amortizations, two different balloon periods. All the terms can be separate. So hybrid, two separate notes. Wraparound, one note that's wrapped around the original mortgage. The most important thing for you to remember, seller financing, they own it in cash. Subject to is when you take over the mortgage. A hybrid is when you do both of those together. A wrap is when the terms don't change, and a hybrid is when the terms could be separate from deal to deal. There are lots of different types of seller carries or seller carry backs that can happen. You can seller finance 20% and get 80% from the bank. You can seller finance 30% and get 70% from the bank. You see this a lot in commercial, right? Where somebody has an adjustable rate mortgage, okay? Commercial loans a lot of times have a 5-year period. The bank goes in first, the seller finances in second, and the banks are very happy with that in the commercial world, right? Motels, hotels, commercial, industrial. You see that all the time. In residential, that's less common, but that's a potential type of deal that can go on. Outside of that, you have all of your transient lending, bridge lending, transactional lending, and fix and flip or BRRRR lending, okay? So bridge lending is typically 12 months. You're just bridging a property. So you're putting money down. Let's say you're selling your house and you're buying another house. You can bridge that time between the homes with a bridge loan, typically 12 months, usually interest only. Fix and flip, that's when you're buying a property. You're typically going to buy it at 70% of the future value. So if you buy an asset that's worth $1 million in the future after renovation, you need to buy it at about $70,000 or $700,000, 70% of the $1 million for this to make sense, okay? Now, the fix and flip loans are typically 6 to 12 months. They're also interest only, and they typically require 10% down on the purchase price of the property, and then they'll fund 100% of the renovation, right? So if you buy the house for $700,000, you'll have to put $70,000 down. They'll give you $630,000. That gets you the $700,000 purchase price, plus another $100,000. They'll finance 100% of that. That's $800,000, right? And then the difference between $800,000 and your $1 million is your profit. Remember, to sell at $1 million, you're going to have to back out 10% for closing costs, agent fees, all that stuff typically. So it's really $1 million minus $900,000. You were all in for $800,000, so $100,000 in profit on the $1 million flip, okay? In addition to that, there are some other loan products that are kind of fancy, like transactional lending, for example, or transactional loans are loans typically for 30 days. And that comes in when you have people who are wholesaling properties. They're buying a house, let's say, for $400,000 and then selling it for $500,000. And instead of assigning the contract, which is when you basically go in, you put the house under contract for $400,000, and then you assign the rights to somebody else at $500,000. That's an assignment of contract. In some states, that's not legal or frowned upon or difficult. And so in those instances, what ends up happening is you can use transactional lending to actually buy it at $400,000 and then sell it at $500,000. So the transactional lending is that $400,000 that you use temporarily to fund the deal. So that's how that process works, okay? These are all the different financing options. Are there more options? Absolutely. There's a gazillion more options that exist out there. But again, QM or qualified mortgages, W-2s, tax returns, basic individual, no crazy situation, bunch of businesses, stuff like that. If you're self-employed or outside those limits, you go into the non-QM world, which is your bank statement, profit and loss programs. If you're doing flips, BRRRRs, rehabs, things like that, you start getting into the specialized financing. Keep in mind that if you are doing a BRRRR, not a flip is when you renovate a property and sell it. A BRRRR is when you renovate the property and refinance it, buy and refinance, okay? When you refinance from a flip, you typically have a fix and flip loan, which again is 10% down for the purchase, 90% funded by the bank, plus 100% of the construction. When that's all done, if you're going to keep the property, they'll let you refinance typically at 70, 75, or 80% loan to value. And that loan product that they give you is in the non-QM world, which is a debt service coverage ratio loan, very, very commonly, okay? So just keep this in mind. You might have to watch this back a few times. But again, the goal of this podcast is to give you guys the distilled down information as quickly as possible on everything I can possibly think of that would be useful. And I'm hoping that this is giving you guys good information. If it's too fast or too slow or you want something different, please drop it in the description so that I can do better giving you guys this content. We're 3 episodes in here. The goal is to get to probably like 100 episodes or something like that. But I'm hoping that this is very educational for you guys. Thanks so much for watching. And as usual, drop me a comment below. Thanks.